Hey there, welcome to the channel. I want to take a look at some of the online car retailers. Okay, so the two companies I'm going to look at today are some of the, honestly, the most horrible ones out there in terms of the stock performance and as well as fundamentals. All right, so here I'm looking at weekly chart for Shift. So I'm going to look at Shift and Vroom. So these are, these companies that try to offer a little bit of a different business model for buying and selling used cars and selling you cars, et cetera, like that. So they've gone and gotten the crap kicked out of them. I mean, Shift has gone below $1. It looks it's like at $1. So it's gone to like nothing. And then Vroom, very similar type chart. It's just gone to nothing. So what the heck's going on with this thing? Well, let's take a look. Okay, starting out with the Shift fundamentals, okay, and we're going to start with like the earnings here, okay. What we have over here is that we can see that this company had some growth, right? So this is a consolidated statement operations, values in thousands. So basically, they had growth year over year. They were growing at like 240%. And then 254. So they had some high top line growth. But then what I do is at the latest quarter here, see what the growth is now. So what happens is these are annual. And what I'm looking at is I'm doing a vertical analysis, kind of breaking things down in terms of where the revenue comes from and what their margin is as a percentage and their costs are as a percentage of the total revenue. So we can see something here that overall, if we look at our cost of sales, we see that for the last 2 years, it was like 93%. And then over here, yeah, like 94%, 92% cost of sales. And what that means is that the gross profit or the gross margin is, what's left, right? So your gross margin that was 6% in 2020 went up, right direction to 7.7%. And then the most recent quarter was down to under 5%. So things have deteriorated in terms of their gross profit. And what that means is their cost of sales went up in this last quarter. Now, they've been losing money the whole time. So you look at the total operating expenses are significant. Here, like in 2020, 45% revenue, 35, and here it's at 30%. Now, although that's improving, it's not enough. A gross margin of only 5% is not really enough in this case to have a profit, because you have what? You have SG&A is really where you have a lot of expenses. So they have, so there's some improvement here. Back in 2020, they were at 42%. They brought that down to 34%, and now they're at like 30%. So, here's a company. This is one of the big issues that they have. They're basically just structurally, they've not got the company to be profitable enough. Who cares about sales? Who cares about growth of, 240% year on year? It doesn't mean a dang thing if you're not making money on the money. So basically the more sales they get, the more they lose. That's kind of where they're at. So let's take a look now. And now it's going to get kind of ugly, because when I go and I kind of took in the latest quarter and I'm looking at their cash flows here, they have cash. And on the asset side, so remember, this is a snapshot. This is on December 31st, 2020, December 30, 2021, last day of the year, 2020. 2021 and the last day of that quarter, March 31st. So what's happening is this is the snapshot, so that you can see the cash equivalents that they got there. Now, their cash went down from 182 million down to 90, call it 95 million. So what's interesting about that, cash burn for the last quarter, all we do is take the difference, and we see that they burnt 87 million in cash, right? But there's something very interesting. How much cash do they have left? The amount of cash that they have is 94. So if I divide that amount of cash that they burnt into the amount of cash they have left, they're not around. They don't even have enough money right now with the current situation to last a quarter. It's shocking. Now, does that mean they're going out of business right away? No, I mean, but they got to do something. They got to get money from somewhere, or they radically have to cut things. So over here on the income side, what do they got to do? Who knows? They got to do something about cutting their SG&A. They got to cut expenses somehow. then on the cash flow, they have to raise money. They're in a desperate situation. Now let's look at the cash flow statement here. We can see that they had a $57 million loss. Where did they get money? Well, in their operation, this whole operation area, you see that they actually used more altogether, nearly $100 million. Then they had some investing in plant equipment and stuff, so that cost them more cash. Where did the money come from? What's really interesting about this one, so if we look over here, we can see that when the cash flow statement, and this is for Shift, you can see that proceeds from the floor credit facility, what's happening here, you can see that they always have this net, often have a net positive in this floor plan, meaning that they're borrowing from it and then they're paying back as they go along. So they're using it to buy inventory, but at any given moment in time, they may have more borrowed than they have. And so they can actually, maybe it gets used a little bit as a slush, not a slush fund. I'm not accusing, I'm just saying, as they'll have some extra money there. So you can see that they got 16 million from it. But another thing too, net cash restricted by financing. So they did something to get 14 million. But here's the thing, they still gave up cash. So they gave up cash overall, 87 million. This leaves them with cash at the end of the period of $106 million. So that's pretty darn danging there. It's like not a lot of cash at all. And, this is a little too aggressive, but so this company is really in rough shape. One other thing that I looked at is they had this data on, they kind of broke up their revenue. So the revenue in terms of e-commerce, wholesale, or other revenue. What's interesting is their cost of sales for the e-commerce is at 95%. Wholesale, the cost is 98.8%. So that means the gross margin on e-commerce is below 5%. So that's not good. But then our wholesale is 1.2. So for Shift, they're in really big trouble. That's all I can say. They're a going concern issue. I'm not a financial guy. I'm not giving you financial advice. I'm just reporting what I see. And of course, there could be errors in this and what I copied, etc. And I'm not a financial expert, but just looking at this, it's pretty bad. They are in a really, really sticky wicket. Okay, let's go look at another one. Let's go look at Vroom now. Okay, so Vroom, let's see what their situation is. On the operations side here, you can see that I have 3 years, 2019, 2021 annual statements here. And you can see that we have sort of similar kind of situations going on here. We have gross profit here and gross margin, about 5%. They got it up to 6%. And then they even on this most recent quarter, they got their gross margin up to 8.8%. So that's actually in the right direction, right? They're improving their gross margin. So that's really good. Where did they do that? How did they do that? Well, the cost of sales on retail, blah, blah, blah. And the gross margin here too, you can see something interesting here. They gave you the cost of sales for the different categories, the retail, wholesale, product, and finance. And what you see is finance is 94%. It's so basically the gross margin, what I'm doing is the gross margins. The gross margin is 94% on finance, because they made 2.7 million on 47 million in sales on the finance. So that's one thing. See, that's something that they're definitely doing right. Okay. They're doing the financing, very high margin, and you can see it there. Now, the only problem is if they could take the vehicle revenue net of 707 million, make that all finance at that margin, they'll be making money, but they're not there yet. So that's what we see there. Total gross profit, 8.8%. And with, a big loss, because a couple things, and this is interesting too, SG&A is 20%, right? And so that's actually went up. This is sort of a problem. SGA is at 20% of revenues, whereas over here it was at 15, 18, 17. So they kind of been losing the battle on SG&A, right? The expenses have been going up for them on that one. And then one other thing to note, goodwill impairment charge at 207 million. Oh man, that's a biggie. That's kind of a biggie there. So let's go take a look at okay, how did they finance this loss? Net loss overall is 310 million. Whew. Now we go to the cash flow statement. losses across all, all the periods here, losses. So over here, I just kind of, it was like they added like 20 new rows of stuff in the latest quarter as compared to what they had on the annual. So I was like, okay, look, I'm not going to do anything. I'm just going to look at the overall. So I'm going to say, okay, net loss 310, net cash in operating minus 15 million. Then over here, net cash used in investing activities, 211 million. Interesting thing over here, the floor facility, they ended up, getting some financing from that at about 57 million. Net cash used, but they really lost. They lost cash in all the categories. Net cash financing was down, net cash investing down, operating down. So, big picture. They started that with 1.2 billion in cash. They burnt 417.25, 417 million, and leaves them with about 800 million. So that's, they burnt a lot of cash. And you see, the reason why is, see over here in some of these other years, like particularly 2020 back here, we'll go down. See that? They did a lot of financing. They did some common stock, but over here they didn't do it. So now they're really kind of in a challenging position, because let's look at their cash flow. So their cash burn last quarter was about that 417 million. And so therefore, let's try to figure out like how much time they have left. So what I'm going to do is I'm just going to simplify. I'm going to take cash and restricted cash and put them together. And so what I'm going to do is over here is say, okay, look, let's look at the cash burn in this. See what I'm doing. So I'm summing both. So I'm going to look at both the cash and restricted cash and just put them together and say, how much did they burn last quarter? Well, they burnt 417 million. Taking that 417 million, what I want to do is I want to take, I'm going to show you this. I want B5 plus this guy. So what I'm doing is I'm summing up the cash and the restricted cash. So I have the total, and that's the amount of cash that we have left, right? And I'm going to divide it by the cash burn that we had in the last quarter. So it's kind of just an estimate, like, well, how many quarters would we last? And, if you're ever working for a startup company that's private and they're, getting A, B, C rounds of financing, you need to do this. You need to know what this is. So quarters to death until they run out of money, given the current situation, 2 quarters. Okay, so once again, not financial advice. I could have made some mistakes or misunderstandings, but the point is, this is another going concern. This company is done. They've got 2 quarters left and they're out of money. They're gone. Then you have SFT, Shift. They are in a similar situation. 1, 2 quarters, they're gone. They're gone. So that's what I see. So there's something very interesting here. So these little companies are, they're struggling. My personal view is I don't think they're going to make it. So I think both these companies, Shift and VRM, they're gone. And therefore that explains why their stocks are at 0. Now, the only way out is acquisition at this point. Here's the deal. That's, as far as I see, that's the only way out for them. It's the only way is if they built a brand or built something that some other company like Penske Auto Group or Asbury Auto Group or some other big company decides that they want them or wants that value, that they come in, they offer something to buy it. But looking at the financials, they look at this too. They know that it's like, oh, these guys are in really deep trouble. They're, they may not be in a rush to go ahead and buy them. Is there any value there? Is there anything that they could do? So look, operationally, they're done. There's nothing left. These companies, like, all they can do is try to hunker down, cut every possible cost. The expansion is done. They don't have money to expand. You can't expand into new areas, new centers, new cities, whatever. You can't do it. You don't have the money to do it. And you don't have the time and money to take the losses that you would need to build it up. The best that you could do is like what we saw with Vroom, where they had a little bit of profit margin on their, basically, right, on their finance. They started doing financing and they're getting some margin. Okay, great. That's if that's the only hope they have, is that if they could somehow expand that financing and get that to be more, a more A larger business, that would be the only thing that would make sense for them. Otherwise, these two companies are gone unless they get acquired by someone else. And what does this mean? What does it mean? Well, you're going to have to go deal with car salesmen again. That's what it means. This whole online model is going to fall apart. These companies were unsuccessful. They were unable. I mean, it's amazing. You're talking about companies that tried to reduce the physical footprint, try to move everything online where the cost efficiencies should have been there. And yet they were unable to be profitable. In 3 years, 4 years, none of these companies had enough profit margin. None of them had enough profit margin to be profitable and to survive. And now we're going into that downturn. So in short, they're done. These guys are done. It's over. That's all for this one.